As the stock market continues to rise, Morningstar's Benz thinks that retirees should start preparing for some market volatility. Christine, thanks for joining me.
Jeremy, great to be here.
So why, after kind of this big run of 8 years, really, of a market rally, should retirees start considering market volatility?
Well, I'm not in the business of making short-term market projections. I really don't know. The market could continue to rally. But one thing I think about is, we do this annual survey of some market experts about what they're thinking about long-term equity market returns going forward, long-term bond market returns going forward. Most of the experts who we surveyed, and we're looking at some strong people here like Jack Bogle and the folks at Research Affiliates and Grantham Mayo Van Otterloo, all tell investors that they should tame their expectations for U.S. equity market returns. In fact, most are forecasting sort of low single-digit real returns or even lower for the U.S. equity market. And that means, to me, we're not going to suddenly wake up and be in an environment where the market returns, say, 2% for the next 10 years. What'll happen is that the market will sell off pretty dramatically at some point, and then it may go back up, but we probably just won't have a steady stream of low returns. So I think we have to brace ourselves for equity market volatility, and I'm a believer in reversion to the mean. We have had this tremendous rally, as you said, Jeremy, really going back almost exactly 8 years. And so investors have to assume that we won't have this uninterrupted upward trajectory, that we will have some volatility and some downswings going forward.
Let's take a look then at how you can brace yourself for market volatility. And the first thing you think is really boosting your cash reserves and making sure you have adequate cash reserves.
That's right. And so, as you know, I'm a big believer of this bucket system for managing your retirement portfolio. And the basic idea there is that you do have enough parked in liquid reserves to tide you through a few periods of equity market volatility or even maybe some downswings in your bond portfolio. So I sometimes shorthand it by saying, well, retirees should have 1 to 2 years worth of living expenses in liquid reserves. But I want to step back and talk about what I'm saying there. And so the starting point really is to think about what your income needs are, then think about how much of them are going to be replaced by certain sources of income. So if you have a pension, if you have Social Security, you can sort of take that off of your need for liquid reserves. What's left over is the amount that you would need to park in liquid reserves. So say my needed living expenses are $50,000 a year. I'm getting $30,000 of that in Social Security, and I want 2 years in liquid reserves. That would mean that I'd have about $40,000 in cash. So don't overdo it, because there is an opportunity cost to having too much in cash.
This could be a good time to rebalance, too?
Absolutely, and I've been evangelizing about this for a few years, and frankly, it hasn't paid off. You would have been better just letting your equity portfolio ride, but when you look at what a 50-50 portfolio 8 years ago would look like today, so a 50% equity, 50% bond portfolio back in March of 2009, well, today, because stocks have performed so well, it would be about 75% equity, 25% fixed income. So investors who have taken a hands-off approach, yes, they've been rewarded, but their portfolios probably have too much risk in them, especially given that they are now 8 years older.
So let's talk about faux diversification. You say this is something that investors really should look to avoid.
Yeah, so if you're going through this rebalancing process, chances are, if you haven't done anything, you need to top up your bond position. And I think the thing you want to be careful about is really reaching for those types of bond portfolios that have performed well in the recent past. So we've seen a great rally in junk bonds. We've seen a great rally in emerging markets bonds. Some of the all-in-one income-focused funds have performed really, really well. So you want to be careful about these products, not saying that you don't want to own them at all, but you want to be mindful of the fact that at the end of the day, we will tend to see them perform at least directionally in line with the equity market. So they won't fulfill that role of ballast that we look for our bond portfolios to do. So if you're topping up your bond position today, I would be adding to the high quality piece of the bond portfolio. Don't get so worried about the fact that there may be some interest rate related volatility. They may not have performed especially well recently. Those are the securities that I think will be there to deliver diversification when the equity piece of your portfolio is going down.
you don't have a lot of control or any control over market returns, but you can control your spending, and you think that's important to keep in mind during any potential market volatility.
Absolutely, and there has been a great and growing body of research in the realm of sustainable withdrawal rates. In fact, our colleague David Blanchett has contributed to this research. And one big takeaway from all of the research, even though the conclusions have varied somewhat, is that it's really important to think about reining in your spending in periods when the market is going down. And the individual for whom this is especially important is the one who is just embarking on retirement or maybe in the first couple of years of retirement, because for such folks, they probably calculated their withdrawal rate based on a pretty enlarged balance. We've had this good market environment. That's the cohort for whom a big equity market downdraft could prove the most disastrous. So if folks have just embarked on retirement, those are the ones who should be paying most attention to thinking about potentially reining in their spending in a period in which the equity market is going down. If someone has been retired for 10 or 15 years, well, they've really made it through the vulnerable period. You're most vulnerable early in your retirement years. You're less vulnerable later on. So they're the ones who can potentially think a little bit less about pulling in their spending, but the early retirees need to be careful.
And finally, do the best that you can just to tune out the volatility.
This is easier said than done for sure. We had a group of retirees in the office filming a roundtable with us for our retirement boot camp coming up. And they talked about that feeling of starting out on withdrawal mode, knowing that they're not going to be adding to their portfolios. That's the group who can feel really, really nervous when the market goes down. So the best advice I can give is just to simply try to tune out the day-to-day market volatility. If we do have some equity market downdraft, it may prove short-lived, it may be longer lasting, but recognize that these things usually do recover. I think that's been one great lesson that we've had. The financial crisis was terrible, investors endured terrible losses, but these things come back and portfolios recover. So I think the best advice is just to try to tune out the noise as much as is possible.
Christine, thanks for your thoughts today.
Thank you, Jeremy.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.